You are quietly losing $312,000. Not to commissions. Not to fund expenses. To an invisible fee that has never once appeared on any statement you've ever received. It gets skimmed off every single trade you place, penny by penny, and 94% of investors have absolutely no idea it exists. Here's how it works. Every time you buy or sell a stock, an ETF, even a share of an index fund through your brokerage, there are two prices. There's the bid, which is what buyers are willing to pay, and there's the ask, which is what sellers want to receive. The gap between those two numbers is called the bid-ask spread. And that spread is where your money disappears. Let's say you want to buy a stock quoted at $50. You see $50 on your screen, you hit buy, and you feel good. But you didn't actually pay $50. You paid $50.03. That 3-cent difference went straight into the pocket of a market maker, the middleman who facilitated your trade. 3 cents. That's nothing, right? That's what they're counting on you thinking. Let's do the math. Say you invest $2,000 a month into a diversified portfolio. That's a pretty standard wealth building strategy. Every month, across all the shares you're buying, you're losing roughly 3 cents per share to the spread. Over the course of a year, investing consistently, that adds up to around $400. Still sounds small. But compound that over a 30-year investing career, account for the growth that money would have generated if it had stayed in your portfolio, and you arrive at $312,000. Gone. Not to a bad stock pick. Not to a market crash. To a fee that was never disclosed on a single statement. Now here's where it gets truly infuriating. Remember when brokerages eliminated commissions? When Robinhood launched and everyone celebrated free trading? When Schwab and Fidelity and TD Ameritrade all followed suit? You thought they were doing you a favor. They weren't. They were changing their business model from one you could see to one you couldn't. The system that replaced commissions is called payment for order flow. Here's how it actually works. When you place a trade on a commission-free brokerage, your order doesn't go directly to the stock exchange. Instead, your brokerage sells your order to a market-making firm. Companies like Citadel Securities or Virtu Financial. These firms pay your brokerage for the right to execute your trade. In 2023 alone, market makers paid brokerages over $3.8 billion for order flow. $3.8 billion. That money came from somewhere. It came from you. The market maker takes your order and fills it at a slightly worse price than what was available on the open exchange. That's the spread. That's the invisible fee. And your brokerage gets a cut for sending your order to the firm that gives you the worst deal. Think about that for a second. Your broker is financially incentivized to route your order to whoever pays them the most, not to whoever gives you the best price. A 2022 SEC study found that orders routed through payment for order flow arrangements received prices that were 65% worse than orders sent directly to exchanges. 65% worse execution. On every single trade. So why don't more people know about this? Because the system is designed to be invisible. Your brokerage statement shows the number of shares you bought and the total you paid. It does not show you what you should have paid. It doesn't show the spread. It doesn't show the payment for order flow. There's no line item that says, by the way, we skimmed $11 from you on this transaction. The SEC requires brokerages to disclose their order routing practices, but they bury it in documents that almost nobody reads. A survey by the Financial Industry Regulatory Authority found that only 6% of retail investors have ever reviewed their broker's order routing disclosures. 6%. Now you might be wondering, is this even legal? Yes. Completely legal. In fact, the SEC has considered banning payment for order flow multiple times. The UK, Canada, and Australia have already banned it. But in the United States, the lobbying power of these market-making firms is enormous. Citadel Securities alone spent over $7 million on lobbying in 2023. Every time regulation gets proposed, it gets watered down or shelved. So what can you actually do about this? The single most powerful move is stupidly simple. Use limit orders instead of market orders. When you place a market order, you're telling your broker to fill your trade at whatever price is available. You're handing the market maker a blank check. When you place a limit order, you set the maximum price you're willing to pay. If the quoted price is $50, you set your limit at $50.01. You control the spread. You eliminate the market maker's ability to fill you at an inflated price. This one change can reduce your execution costs by up to 80% according to research from the Journal of Financial Economics. Second, consider your brokerage carefully. Not all brokerages are equally aggressive with payment for order flow. Some, like Interactive Brokers on their Pro plan, route orders directly to exchanges and pass along price improvement to you. You might pay a small commission, maybe $1 per trade, but the execution quality saves you far more than that dollar costs. Third, trade less frequently. Every trade is another opportunity for the spread to eat into your returns. This is another reason why buying and holding index funds for the long term outperforms active trading. It's not just about avoiding bad picks. It's about minimizing the number of times the invisible fee gets applied. And fourth, check your trade confirmations. Compare the price you paid to the national best bid and offer at the time of execution. Your brokerage is required to provide this data if you ask for it. Most people never ask. Here's the uncomfortable reality. The wealth gap in this country isn't just driven by income differences or investment knowledge. It's driven by systems that are specifically engineered to extract small amounts of money from millions of people who don't know to look for it. Institutional investors negotiate their execution quality. They demand best pricing. They have teams dedicated to minimizing spread costs. Retail investors, the people watching videos like this trying to build wealth the right way, get the worst fills at the worst prices because their brokers are selling their orders to the highest bidder. $312,000. That's not just money lost. That's years of retirement. That's a house paid off. That's generational wealth. And it evaporates 3 cents at a time while your brokerage sends you emails celebrating commission-free trading. Now you know. And knowing means you can fight back. If this changed how you think about your brokerage, hit that like button. Subscribe if you want to keep catching the traps that nobody else is talking about. And next week, we're breaking down another financial system that's quietly funneling your money in a direction you never agreed to. You're not going to want to miss it.